So, Dr. White, we're now going to talk specifically to the business owners, the doctors that have gone into private practice, whether they've opened up their own practice, they've acquired a practice themselves, or very commonly, they've gone into business with other individuals and they have a partnership or their shareholders filed as a corporation, right? So, I want to first ask you, because, and again, just to actually keep going here for a second, we're not talking about the liability insurance. We're not talking about the E&O. We're talking about protection planning for business owners when it comes to anything that can happen via life, happening where there's death or there's disability, right? Very common for doctors to become disabled. They develop arthritis and, the oral surgeon can no longer operate. The DDS can no longer operate, right? So, it's very common, to, have these certain protections in place. And we want to ensure that, as a business owner, you also understand what's out there. And if you need a little bit more guidance, we're here for you from that. So, first and foremost, Doc, I want you to open up just by kind of explaining your process of how you became a business owner. How did you acquire a practice? Did you build your own? Did you start from the bottom? How did you actually, get to be a business owner? And then we'll dive a little bit deeper into how did you understand the protection plans that were out there, and what did you actually do when it came to your protection plans?
Absolutely. So when I finished my residency, I went to work as an employee for another doctor for about a year. And then after that, I purchased a existing practice with a partner. And that was always my goal. One of the things that drew me to the profession was the ability to own your own business. And I'm actually seeing that more and more commonly now amongst my colleagues, where maybe 10, 15 years ago, there was a lot of doctors going into working for large hospital groups. Now we see more and more going into practice groups with partners where they are part owners and they have skin in the game. So we're actually seeing the ownership side of the medical profession grow. And that was appealing to me. We started the practice and started growing it very quickly. We took over a smaller practice, added a lot of different procedures, and we're off to the races in a few years.
Which is interesting, I think, because a lot of doctors, especially when they're first starting off, maybe they finish their fellowship or whatnot, they like the comfort of being in that procedural way and kind of growing throughout that hospital or academic type of environment. Where now, as you just said, they're creating their own procedures. They're going and they're taking a risk on themselves, ironically, to really try to build something great because they like the feeling of skin in the game. So when you first started getting into, building your own procedures and having the fun of, coming up with marketing strategies and really, taking on the operations of building a business with other partners, were you thinking about protection planning at that time? Was it something that you were familiar with? Did you have an advisor that was, instructing you on how to protect the business properly? What was your take on protection planning when you first opened your business?
Yeah, absolutely. Well, the first thing that, as all doctors know, that you have to have is malpractice insurance, which was the E&O that Matt had mentioned, which is the broad term called errors and omissions, but of course for us it's called malpractice. That's sort of ingrained into us. So that's a no-brainer. And although that's not something that we do, it's certainly something that every doctor should have.
Has to have.
Has to have. It's a requirement pretty much in every state to have that, to be contracted with insurance providers or sometimes even to just have a license. And the other side of that is, of course, liability, which is just general slip and fall. Those are kind of the easy ones that we know we need to get, and we get them out of the way very quickly. What I was less familiar with is other ways to protect the business in a long-term way. Not against the liability or something going wrong with the procedure, but something going wrong with the partners in the business. And unfortunately, by not being as familiar with that, that's something that a lot of us can slip up on and not get the right coverage. I actually didn't have an advisor that gave me good guidance on that because, again, I was focused on the basic protections that we all know, and I actually missed out on that. So, in my story, what happened was that we didn't really have any sort of protection for one of the partners becoming disabled. Now, I had it personally, so I was able to get some income to supplement the loss of income that I experienced after I had my shoulder injury and was unable to practice. However, the practice suffered. And the problem there was that I was not able to go back to surgical practice. So I had to step away. I was still doing some management, but the practice wasn't able to fulfill all of the needs of the patients. We brought in some associates, but they weren't producing to the same level as I was. And that put the practice in a difficult situation because my partner, who had her own specialty that she was great at, wasn't able to take over what I was doing. The associates weren't either. And the practice ultimately suffered and lost a lot of its value.
So, Doc, without that protection and, when it comes to the type of work that we do, there is a way to protect against that situation specifically. Before I get into details on what those protections are called and how they operate, what happened to the practice in terms of, did you have to get bought out? Did there have to be a lot of money at stake? Was the financials of the business extremely affected because you weren't able to operate, literally, and the associates that you had brought in weren't able to be as effective and efficient as you were? What happened to the business?
Yeah, so actually the practice suffered over 50% loss in revenue over the few years that after I became disabled, and eventually basically got sold for pennies on the dollar just to pay off the loans that we had. So we went from a practice that was doing extremely well and growing year after year, that had a great value that could have been sold to another group and would have been a great exit plan for both myself and my partner, to basically being sold for its sort of cash value and not resulting in any types of return to either myself or my partner.
Wow. So looking back, what are some things that you wish you had done differently in order to protect the business that you now know exists? And I'm not asking you to go into the details necessarily on what those protection plans are, but just how would you have gone about the planning process of getting the business ready to really be fully operational differently now than you would have back then?
Yeah, so one of the key things that I learned is that if something happens and a partner becomes disabled or, God forbid, dies, the practice immediately suffers. Because at that point, somebody that's going in to potentially buy it or even lend you the remaining partner to buy out the other partner, the valuation of the practice has already suffered, and you're either paying a higher interest rate or you're not able to cover the full amount of what that buyout should be.
And I was going to say that too. It requires some amount of capital regardless.
Right.
It's not paid for via an insurance policy, which is available.
Right. And so there are actually ways to do it with insurance where you plan ahead. And if we had planned ahead, for example, we would have put in place policies that not only protected myself if I became disabled, but actually would have protected my partner and the practice, the equity of the practice, if I became disabled, so that on disability, an immediate effect would have occurred, and this is called a buy-sell agreement that Matt will talk a little bit more about later, that would have kicked in with an insurance policy that would have funded the actual purchase of my share of the practice, which then would have allowed my partner to continue operating the practice and me to have the exit that I would have normally had. And that's something that needs planning ahead of time, because unfortunately, once that disability or death has occurred, it's too late. So it's something that you need to put in place as you are forming the practice. Exactly, once the partnership is formed.
Also, when the business valuation is lower and there's less complexities involved in the partnerships or the shareholders, depending on how the business is filed, from a legal perspective, it becomes more simplistic, and it's easier to add once you evolve than it is to start once you're already at that complex stage. Right now, Doc, I will say, I just want to touch on the two ways that the business could have been, more, beneficially impacted with your situation. Now, obviously, nobody plans for a disability in terms of personally, right? We all think we're good. We don't think anything's going to happen to us. But ladies and gentlemen, things happen, right? The first one was the buy-sell, right? So quick scenario, Dr. White goes into a private practice with one of his classmates, and there's a 50-50 partnership on the business. I'm not going to get too in-depth, but just know, whether it's 3 partners, 4 partners, whatever it is, you can actually buy a insurance policy that covers the amount of equity on the partner. So if the business simply is stated is valued at $5 million, okay, and Dr. White, you're a 50-50 partner, and the other individual is a 50-50 partner as well, you can put a $2.5 million insurance policy on the individual, so that in a God forbid situation via death or for disability, that $2.5 million legally buys out Dr. White from the business when that situation occurs. Hopefully it never does, right? But if that didn't occur, regardless of having to buy out with capital and whatnot, the insurance policy would buy that out. But additionally, the equity in the business would go to either your estate or your spouse. Now, I'm sure Dr. White, your partner, was very fond of your wife, right? But at the same time, I don't know if they want to be in business together. Right. So it's not just buying out the equity to have the business stay afloat, but it's also legally binding those dollars to buying out that individual from the practice. The last thing I'll say, which was, well, the business financials were taking a loss 50% over and over. In addition to the buy-sell, there's also something called a key man policy. And that key man policy specifically says, and the typical rule of thumb is 10 times salary. So if Dr. White, or 5 times salary, depending on the business, and the growth of the business, the revenue, the financials, things like that. But let's even call it a 5 times salary. If Dr. White's making $1 million a year, right, there would be a $5 million insurance policy owned by the business on Dr. White, so that if something happened to you, doctor, via death or disability, such as your shoulder, the business would actually get $5 million to replace you. So in addition to the buy-sell, which would buy Dr. White out and give him that money, right, to get the equity back in the practice, that key man policy or key executive policy would be utilized to protect the business, so that if something happened to Dr. White, the business gets the proceed to find a new replacement, to market, to hire maybe a third-party recruitment company, to provide a huge sign-on bonus to that top doctor to join the firm, right? So there's things that can be put in place that can ultimately protect the business in a variety of different ways that, Dr. White, I think you would attest. If you had some of those, your business would have been in a lot different shape.
And that's really important, because sometimes we have a complete rock star office manager that really runs the day-to-day operations of business, and if that person is out, it becomes extremely challenging. So that's a type of key man that would be covered. And then in a lot of group practices, there may be some rock star employee doctors that maybe they're not interested in owning the practice, or they're on their way to earn into the practice or buy in.
They have a lot of potential.
They have a lot of potential, but they're relatively early in their career, but still a loss of that doctor is very challenging, especially right now. To hire a good employee as an associate, that's what we ran into. That was very hard, because a lot of the really great doctors at the peak of their career, they actually want to own a practice. And so if you lose a great associate that is in the process of buying into the practice, that completely messes up your plan. So having that key man policy on that person helps you get things back on track and hopefully restart that process with someone else and so on.
Totally. And I think that's actually a really good segue into understanding a little bit more about the 4 areas of protection planning that business owners can take on, right? We covered the buy-sell agreement, right, Doc? We're protecting our equity in the business with our partners. God forbid something happens to us via death or disability. The insurance policy is utilized to protect the business and to buy out that other partner that becomes disabled or dies from their family, right? By law, by contract law, right? Used with an operating agreement drafted by an attorney, okay? The next is that key man policy, right? So God forbid Doc becomes disabled, not just the buy-sell, sure, he's bought out, but the business owns a policy on a doctor, office manager, someone that is critical to the business, right? By the way, can be done through term insurance or permanent insurance and be utilized as an asset on the books for the business. As we talk about whole life as an asset, one way for doctors, to have a little bit of assets on the books is to do a key man policy through permanent life insurance. But basically, that key man policy is used to pay the business back in case that individual were to become to die, right? So the other way is business overhead. Doc, did you know anything about business overhead expenses? Was that something that was important to you? What is your understanding of business overhead expenses?
Yeah, so it's something that was basically to me, was kind of a tag along to the personal disability insurance. And the way it was presented is, well, you have your personal expenses that you need to cover if you become disabled. So that made sense. I went with that. The business overhead is similar, but instead of protecting your personal finances as a doctor, it protects the finances of the business. And at that time, it didn't really strike me as necessary because we thought that we could hire somebody to take over my place, or I was really probably a little selfish and only thinking about myself and getting the disability coverage for myself. And I figured the practice
which everybody should have nonetheless.
Of course. And very quickly, once I did have the disability, I realized that the practice was suffering, and if it did have that business overhead insurance, that would have given it the leeway, not necessarily to pay the basic bills that were being covered, but more importantly is pay for the replacement doctor. And that was really the key, because we always looked at, as practice owners, we tend to sort of forget our salary as an expense of the business, right? So however we take it, we look at the rent, the supplies, the staff expense, and
utilities, equipment, payroll.
When you do a quick calculation, sometimes that is not the most significant part of the expenses of practice. For most practices, the largest expenses are the doctor's salaries themselves. And when you lose that, you have to replace it. And when you have business overhead, that can really help solve that issue, because all of a sudden you're able to have that money to hire either a temporary doctor to take your place while you're on disability, or a permanent associate to take your place to keep the practice afloat. But all of those, temporary help as well as a permanent associate, they're very expensive. And they, in some cases, can be more than the base expenses of the practice. So even though you might think you have enough to cover the operating costs of the practice, unless you want the practice to suffer from a lack of production, like what happened in our case, you need someone to be able to go in there and continue doing the procedures that you were doing if you go on disability.
Yeah, and that business overhead, is simply through disability, right? There's no life insurance involvement with business overhead. But what it does, it protects, the payroll of the business, the expenses of the business on a monthly basis, so that if, that business owner became disabled, ultimately everything could be paid for. We call it a keep the lights on policy, right? It keeps the lights on. The final way from the protection side that we would like to talk about just very briefly here is something that Dr. White had alluded to a little bit, was right now it's very, very hard to hire associates, right? You have a private practice, it's very, very hard to hire good quality associates. So one way, in addition to key man, that we like to look at is a way, when you think of the word protection, it's tend to be thought of as a negative connotation in terms of, man, if something happens to me, then I need to make sure that I'm good. But also from a protection of the business, I think it would be a lot more weight off of your shoulders if the doctor knew that he could create something, or the business owner knew that he could create something that's more of an incentivized strategy, where the doctor or the associate, the up-and-coming star at the practice, is more inclined to stay, right? There are ways in which we can do this, and I'm not legally allowed to give tax advice, but there are ways that it can be tax beneficial for the business as well, where you can create incentivized strategies for those associates that are either at your practice right now, or utilize them as a recruitment tool to attract talent when you're in an interview process with that associate. So when it comes to that, Doc, when you were hiring those associates, what were you trying to do to attract talent? Because nowadays, as you mentioned, it is very hard to get just general talent in the building.
Yeah, so we focused on a couple of different things. One is a friendly, high-tech work environment. Our practice was on the higher end. We were using a lot of top-of-line technology that a lot of the younger associates were interested in being involved in learning and working with. We also worked at providing mentorship, because that was one of the things that I was passionate about. I taught at the local dental school, and so that was something that we offered as well. Obviously, a competitive salary. In our case, we were paying a percentage of the amount of the production that the doctor was going to provide, with some minimums to give them the comfort level of when they're first starting out. One of the things we didn't really do is we didn't look at that broader package, and that is definitely a way that you can set yourself apart. especially when you're talking about some tax advantage ways to structure those so that, at the end of the day, any associate is going to want to have a disability protection policy. They're probably going to want to have some sort of life insurance. If I was an associate, I would want that. So I'm either going to pay for that out of my own pocket from the salary that I receive, or if it's structured correctly, and if it's a good option, I would love to receive that as a benefit from the practice where I'm working.
Well, not just that. I mean, I think as associates graduate from residency and fellowship, they're kind of itching at the bit to get money in their pockets. Right? So there's a unique way, whether it's attracting associates or even more senior talent, that there's just an ability to create a tax favorable allocation of business assets to that talent that helps with retention, helps with attraction, and really can put the business on a pedestal, showing how much they care about those employees. By the way, it doesn't just have to be those doctors, that office manager, right? Again, back to that key executive policy. It's a way to help protect the business by not just through death or disability, but by keeping the top talent, right? That's protecting the business, is ensuring that the top talent doesn't leave the door because, doc, yeah, we can buy a life and a disability policy for a doctor, but at the same time, someone comes along and offers them $100,000 more a year, who are they to say no, right? So we need to come up with creative ways to protect our business to maintain our top talent. And that's something that we focus on as well. Now, one of the things that I want to bring up too is, and I know we covered a lot here with buy-sell agreements and key man policies and business overhead expenses and executive retention tools. I want to just say to all the business owners though, it doesn't matter which stage you're in the business, whether it's in the startup phase, the growth phase, their maturity phase, or even the exit phase, right? All of these things need to be considered at all times because, for instance, everything could be going great, and you could be in the startup phase when you implement your buy-sell agreement. Matt, got $1 million business loan, business is valued at $5 million, $2 million, $3 million, whatever it is. We have our buy-sell, everything's good. But what if you don't review that, doc? What if you let that go 5, 10 years? You scale your business. Instead of being worth 2, 3, now you got 10 dental offices, and the business is worth $30 million. Well, guys, if that buy-sell isn't reviewed on a daily basis, and God forbid something happens, and you still have that 2.5 on one and 2.5 on the other, and that business is worth $30 million, by law, that doctor can be bought out. If he dies, that doctor's family can be bought out by that $2.5 million. No ifs, ands, or buts about it. What we're getting at here is we're not just here to sell you something. We're here to be consultants for you and to take you along a protection journey because it's not just a one and done. These things need to be consistently reviewed, consistently evaluated, consistently analyzed to ensure that what is in place is up with the times of the business.
Exactly. And that's just like treating a patient. You don't see them once for treatment and then see them again in 10 years. You want to follow up and make sure that whatever their situation is, they're being adequately cared for. And if they have changes in their health, those need to be addressed, maybe with different treatment or different type of interventions. And that's the same thing for any type of business protection, or even in general, any type of personal protection strategies that we implement. We always welcome you to get back in touch with us, have a complimentary review of what's going on with your life and your business today, and make sure that all the strategies you put in place before, you can go ahead and update them. And we're happy to do that for anything that we've done for you, as well as if you had an advisor in the past and maybe you want a second look, we will be there for you and make sure that happens and that you have the most up-to-date policies and plans and strategies for your business.
And not just up-to-date. I think the real word is adequate, right? We want to make sure that it's adequate. You have to have the right agreements. You have to have the right legal contracts in place too. Again, we're not attorneys, but we work hand in hand with attorneys. We work hand in hand with CPAs. We work hand in hand with investment advisors that all are a part of those doctors' lives. where Dr. White and I come in for the business owner is bringing that protection piece together. And by piece, I mean that puzzle piece, right? It's a big puzzle. We have this, we have that, we have estate planning, we have, income plan, we have investment plan, we have all these things. We are the we are the protection specialists that come in here and say, where's the protection at the business? Again, not from a malpractice perspective, not from a liability perspective, but in a God forbid perspective, is the business protected itself with the major dollars that are at stake? That's where we tend to provide the most value to our clients. Doc, is there anything we missed?
I think we got it pretty well covered for business protection.
Yeah, no doubt. So again, as Dr. White said, if you have any questions, feel free to shoot us an email. We're happy to, hop on a phone call, have a review, do however you think is best. And, we look forward to hearing from you. Thank you so much.
Thank you.